Have you ever wondered how to start investing when you finally have some extra cash? Maybe you're sitting on your first $10,000 and thinking, where do I even begin? Well, you're in the right place. Today, I'm breaking down exactly how I'd invest my first $10,000 if I were starting completely from scratch. I'll share how I'd split it up, my personal strategies, and the mindset that helped me grow my portfolio. But here's the thing. You don't need a massive paycheck to start building wealth. If you stick around until the end, I'll reveal a powerful move that could help you build wealth faster, even if you're just getting started. I'll be sharing with you 4 tips that you'll need to help you invest your first $10,000 as a beginner. Ready to take control of your financial future? Let's dive in. 1. Investing in the S&P 500 around 3 to 4K. If I were just starting out with investing, I'd focus on keeping things simple yet effective. My first move would be to invest around $3,000 to $4,000 into an S&P 500 index fund. Now, you might be wondering, what exactly is the S&P 500? The S&P 500 stands for the Standard & Poor's 500, which represents the 500 largest and most successful companies in the United States. Think of it like a collection of powerhouse businesses. Apple, Microsoft, Google, Coca-Cola, Amazon, Visa, Home Depot, and even Waste Management are all included. These companies have a long history of generating profits and staying strong, even during tough economic times, making them a safer choice for beginners. It's a great way to diversify your investments because, with just one share of an S&P 500 fund, you're spreading your money across big companies like Apple, Amazon, Coca-Cola, and Home Depot. These companies have a solid history of making profits and surviving tough economic times, making them a safer choice for beginners. As a beginner, I wouldn't recommend picking individual stocks. Trust me, I've learned the hard way with stocks like Honda and random penny stocks that just didn't work out. So for me, diversifying into the S&P 500 is the way to go. When you buy shares of an S&P 500 fund, you're investing in a broad range of well-established companies that have proven to be reliable over time. When I first started investing, I made the classic rookie mistake. I tried picking individual stocks, including risky penny stocks and shares in companies like Honda. And guess what? I lost a lot of money. Trying to guess which single company will take off is risky, especially when you're just starting. If I could go back and give my younger self advice, I'd say, stick with the S&P 500. Which S&P 500 funds should you consider? There are multiple ways to invest in the S&P 500, and a few popular options you can check out are VOO, Vanguard S&P 500 ETF, SPLG, SPDR Portfolio S&P 500 ETF, IVV, iShares Core S&P 500 ETF. These funds are all designed to track the same 500 companies and offer diversification at a low cost. The main difference is the fees and share price. If you're working with a smaller budget, SPLG might be a good choice since it has a lower price per share. But ultimately, all these funds aim for the same result, giving you broad exposure to the best performing US companies. What can you expect for returns? Historically, the S&P 500 has returned an average of 7% to 10% annually. Some years, the market may drop, while other years it can surge even higher. The key here is patience and long-term consistency. The longer you stay invested, the better you can ride out market fluctuations and benefit from long-term growth. If you're a beginner looking to build wealth, the S&P 500 is one of the smartest and simplest ways to get started. It's diversified, reliable, and has a long history of solid returns. Trust me, focus on consistent investing rather than trying to pick individual winners, and you'll set yourself up for success over time. 2. Technology stocks around 3,000. The second place I would invest my money is in something focused on technology companies, like the NASDAQ 100. Now, what exactly is the NASDAQ 100? It's a group of the top 100 technology-focused companies in the United States. Think of it like a basket holding some of the most successful and innovative companies out there, such as Apple, Microsoft, Tesla, and Google. Why focus on tech companies? Well, tech companies often grow faster than businesses in other industries because they're constantly developing new products, services, and innovations. For example, think about how Apple went from just making computers to dominating the smartphone industry with the iPhone. Companies like these have the potential to grow rapidly, which can increase the value of your investment over time. However, there's a catch. Tech stocks can be a bit unpredictable. Since technology companies rely heavily on innovation and consumer demand, their stock prices can go up and down more than other types of investments. For example, if a company releases a disappointing product or misses sales expectations, the stock might drop quickly. On the flip side, if a tech company launches a groundbreaking product or reports high profits, the stock can shoot up just as fast. If you're the type of person who feels stressed when the value of your investments drops temporarily, tech stocks might feel a bit risky for you. However, if you're comfortable with a bit of risk and can keep a long-term mindset, tech stocks could offer great potential for growth. How I would invest in tech. If I was starting from scratch and wanted to invest in tech companies, I'd go with something called an ETF, Exchange Traded Fund. An ETF is like a collection of many different stocks bundled together, so you don't have to buy individual stocks one by one. This helps spread your risk because you're not relying on just one company to do well. You're invested in a group. For tech investing, the Nasdaq 100 ETF is one of the best options. A few popular ETFs that follow this index include QQQ. This is one of the most well-known Nasdaq 100 ETFs. It gives you exposure to top tech companies like Apple, Amazon, and Meta, formerly Facebook. QQQM. This is a more affordable version of QQQ. It tracks the same companies but has a lower share price, making it great for those starting with a smaller budget. Both of these ETFs hold shares in leading tech giants, giving you a simple way to invest in multiple tech companies at once without having to choose individual stocks. How much would I invest in tech? If I had $10,000 to invest from scratch, I'd consider putting around $3,000 into a tech-focused ETF like QQQ or QQQM. This way, you're giving your portfolio the potential for high growth while balancing the risk with other investments, such as the S&P 500 or dividend-paying stocks. The Nasdaq 100 is similar to the S&P 500, but focuses on the top 100 tech companies in the US. Some examples of ETFs that track these tech companies are QQQ, and if you want a cheaper option per share, QQQM is a good choice. These ETFs include big names like Apple, Microsoft, Tesla, and Google. While some of these companies also appear in the S&P 500, the Nasdaq 100 is more tech-heavy. If you're just starting out and want something more affordable, QQQM is also a solid alternative. The Nasdaq 100 has shown some incredible growth over the years, but if you're someone who can't handle the occasional correction or pullback, then you might want to tone down your exposure to tech stocks. Tip 3. Dividend-paying stocks, around 2,000. The third type of investment I would recommend is ETFs that focus on dividend-paying stocks. These stocks might not grow as fast as tech companies, but I like them because they pay me dividends regularly, either monthly or quarterly. One of my favorite dividend-paying ETFs is SCHD. It includes solid companies like Pepsi, Coca-Cola, and Home Depot. While these stocks may not grow as quickly as tech stocks, they are often more stable, especially during market downturns. On the other hand, dividend-paying companies usually hold their value better, even in tough times. So if you like the idea of earning regular payouts or want a bit more stability in your portfolio, adding dividend-paying stocks and ETFs like SCHD can be a good move. 4. Cash reserve, around 1,000. Lastly, I always keep some money in cash, around $1,000 in this case. A lot of people criticize me for holding cash, but it's important for me to have a cushion in case the market pulls back or corrects. This way, I have some cash to deploy when prices go lower, so I can buy my favorite assets at a discount. If you're using a platform like Fidelity, you can earn interest on uninvested cash, which is a nice bonus. My Fidelity account, for example, puts uninvested cash into a money market fund that currently earns about 4.9% annual interest. Not bad for doing nothing. Portfolio allocation ideas. Here's how I would break down my $10,000 investment. Balanced option, $4,000 into an S&P 500 ETF, like SPY, for stable, broad market exposure. $3,000 into a tech-focused ETF, like QQQ, for some growth potential. $2,000 into dividend-paying stocks, like SCHD, to earn regular payouts. $1,000 in cash for flexibility and safety. Aggressive option if I were younger. $5,000 into a tech ETF, like QQQ, to focus on high growth potential. $3,000 into an S&P 500 ETF, like SPY, for stability. $2,000 into dividend stocks, like SCHD, for income. Conservative option, focus on income. $4,000 into an S&P 500 ETF for broad market exposure. $1,000 into a tech ETF for a bit of growth. $4,000 into dividend ETFs for consistent income. $1,000 in cash for security. This approach balances risk and reward, with flexibility to match different investing goals and timeframes. If you want to keep things simple, you can just invest everything into one S&P 500 ETF, e.g. SPY or VOO, and hold some cash on the side. But again, this is your money, so make sure you choose what feels most comfortable for you based on your risk tolerance. In the end, the key to investing is finding a strategy that works for you. You don't have to follow anyone else's plan, including mine. Take your time to understand the different assets available, and don't be afraid to experiment a little with what works best for your financial goals. Thanks for watching, and let me know in the comments how you would invest your first 10K. Don't forget to like, subscribe, and hit the bell icon for more personal finance and investing tips. Catch you in the next one.